Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcast.
So, when we're using a confirming indicator, again, our success in the markets in trading not just these FX currency pairs through the IC, but any market for that matter, is about putting the probabilities on our side. And we use chart patterns and indicators to help us make educated decisions. But we're still, we're looking for that confirmation of direction by applying lower indicators to our charts. And if everything lines up, as I said, we're building a case for a particular directional bias. If everything lines up and everything agrees, then we have a higher probability of being right, which is really what this business is all about. Now, there's a quote from John Bollinger that I've included in here, and mainly because I like the word that he uses. It makes me sound smart, but he suggests that there's a cardinal rule for successful trading or successful use of technical analysis, and it's avoiding multicollinearity amid indicators. Multicollinearity is simply the multiple counting of the same information. The use of 4 different indicators all derived from the same series of closing prices, essentially to confirm your directional bias, is a perfect example. So to sort of give you an idea of what I mean, when we're looking at momentum indicators, there's a few that we can choose from. We've got our RSI, which we're going to talk about tonight a little bit, stochastics RSI, CCI, which is your commodity channel index, your Williams percent retraceable. The idea is that you don't want to have all of these on your same price chart because they're essentially telling you the same thing. If we move into our trend indicators, we've got our moving averages, our MACD, and our average true range. Now, I'm sure there's going to be questions on, what each of these mean, but the idea is that I want you to just understand that it's not about how many of these you're applying to your price chart. It's about how effectively you're using them and you're managing your risk by digesting the information. So you don't want to clutter up your price chart by too many of these indicators. Make sure that you're not including indicators that are essentially telling you the same thing. If we look at volume here, we've got accumulation distribution, on balance volume, money flow index, the Chaikin money flow. So those are some examples of some volume indicators. So realistically, just pick one from each category to apply to your price chart, and you'll avoid that sort of mess of indicators there, which ultimately just ends up in making your trading decisions much more difficult than they have to be. On that note, let's have a quick look at our MACD. Now, MACD stands for Moving Average Convergence Divergence. It's a very popular lower indicator, and really what we're looking at doing is identifying, overbought and oversold conditions, essentially where trends, say to the upside, are starting to lose strength, or trends to the downside are starting to lose strength, and we're doing that based on price action. And we're also, and I'll give you an example of this, we're also looking for convergence and divergence between the oscillators and the price, warning us of a possible change. And I'm going to, before everybody panics, I'm going to actually give a couple of examples of that. But the idea is that, even though the price action may be telling us one thing, as that forensic investigator, we're looking for clues that are maybe telling us something else, so that we can maybe make a decision a little sooner than later. Now, what this particular indicator does is it uses 2 moving averages. The most common are the 12 and the 26, and those represent bars. So essentially, what this particular oscillator or indicator is doing, measuring the previous 12 bars, measuring the previous 26 bars, and then plotting a line. And that represents the slower sort of range of the price action. And then a third bar, which is generally a 9-day, is plotted, and that's used as what's referred to as a signal line to help us aid with trade entry and exit. So let's look at an example. We'll use the EUI again, the U.S. versus the Euro. And we were referencing the possibility of identifying a an entry point based on our move to higher highs. You'll notice that as prices started to break into those higher highs, here we had a trend which was indicating a continuation to the downside. Your red line represents your longer time frame, the 12 and the 26. Your blue line here represents your signal line. So if we go back, you can see here as prices were moving down, our blue was below our red. And as we started to get a crossover here, you can see the trend had changed. So we're really looking at this sort of historical reference as a means of building a case for a future price move. So here we're looking at a previous pivot point. We're looking at the break above that pivot point and the confirmation that our preceding downtrend has lost strength and that we're potentially entering into an uptrend. Now, again, not to forget about the whole concept of support and resistance. We have to recognize that as prices play into these higher resistance levels, the possibility of a rejection here is something that we have to note. Now, if you have one contract, you might subscribe to the old adage, target one, take the money and run in the sense that you've made some money, you've hit your first target, it's time to get out. If you're trading multiple contracts, this might be an area where you say, okay, I think there's a possibility for a further move to the upside. Let's take a few positions off the table, move our stop maybe up to break even on our option contract, and let's see where this thing goes from there. And then, of course, target your key resistance areas as prices start to trade into them. You'll notice here, as we played into this second resistance level here, that our MACD started to show some signs of weakness. And right there, although that's not a 100% guarantee that prices are going to turn around, it's a pretty good indication that there's some weakness setting in. And again, ounce of prevention is worth a pound of cure. If you've made some decent money, one way that you can manage this is, again, if you're trading multiple contracts, take a few off the table, move your stop up here somewhere, and then just see where it takes you from there. But the idea is that we're looking now at a combination of our MACD and our support and resistance levels and pivot points to help make an effective trade decision. Now, in saying that, you can see here that we have prices playing into higher highs, culminating with this sort of change right in here, which represents, I guess, again, in our bigger picture, that was a key area of resistance, although not identified here. But the one thing that we're looking at is prices playing into these higher highs, but if we go down here, we talked about the concept of divergence. Look at your histogram here as sort of a measure of momentum as well. And as you're playing into these higher highs, really, quite simply, this what we refer to as a histogram is measuring the distance between your short-term price action and your longer-term price action. When that distance starts to tighten up, the probability of a change of direction becomes higher, and we can use that as a little bit of a heads up with respect to staying with the trade any longer. So this is actually, as I said, referred to as divergence. Prices are moving higher, but your MACD histogram is suggesting that there's weakness in those new highs. When I reference the idea of trying to chase the market when we're breaking into all-time highs, one thing that you can look at is this very sort of characteristic here. And if you see that although prices are getting higher, there's divergence taking place in your histogram, that is a signal to maybe stay out of the market with respect to going, in this case, long, and wait to see what happens on a pullback. So we're just trying to put a few pieces of the puzzle together as we move forward.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.